Welcome to Other Deep Dive. Today, we're really cracking open some fascinating source material. It's rooted in Jack Schwager's book, Hedge Fund Market Wizards.
Yeah, pulling back the curtain, looking at the minds, the strategies, the actual experiences of some truly legendary macro traders and investors.
And our mission here is, well, it's to distill the core insights, those vital nuggets of knowledge that help explain how these, well, wizards navigate the huge global markets.
Right.
And what's really interesting, I find, is there's no single secret formula here. Not at all.
Yeah.
You see these wildly different approaches, but woven through it all are these fundamental principles and
Yeah.
unique perspectives that offer, I think, just incredible learning opportunities for you listening.
Absolutely. We'll explore how they spot those major macro forces, how they hunt for mispricings that, the rest of the market just misses, how they manage risk when, billions are on the line, and crucially, the psychology, the
Yeah.
role that plays in their success. It's huge.
Okay, let's unpack this then. Let's start with that foundational idea,
Yeah.
understanding the bigger picture. One source tells this story about a character, Mr. Partridge. He points out that, yeah, reading the tape, the price action, that's important.
Sure.
But you're missing, well, everything if you don't see the larger trend. It's not just noise, right? It's about finding that dominant macro force.
That story is so key because successful macro traders, they aren't just looking at squiggles on a screen.
Right.
They see those squiggles within this huge context, global economics, policy shifts, fundamental forces. If you ignore that macro trend, that's fundamentally why so many traders struggle. They just miss the forest for the tree.
And talking about economics, these sources have this really interesting critique of how the field evolved. Started almost like, well, philosophy.
Yeah.
Then it became this super mathematically rigorous thing. But, and this is the catch, to make the math work, they often made this giant assumption: efficient markets.
Which raises a really important question. Why? Why does that academic need for mathematical neatness, tractability, so often lead to assumptions that just ignore the messy human reality of how markets actually work? It's a fundamental disconnect.
You see that disconnect playing out so clearly in macro situations. You remember the UK trying to stay in the ERMs, and the European exchange rate mechanism?
Oh yeah, classic example.
Sources use that one. Policymakers, they wanted control. But the fundamental situation, a recession, an overvalued currency pegged way too high, forcing these punishingly high interest rates just to match Germany. It was just impossible.
Utterly untenable.
Trying to prop up the pound against those forces, it was like fighting gravity.
Exactly. And ultimately, fundamental economic reality, it just wins out. Which leads to another really crucial insight from the sources. Macro markets often aren't efficiently priced, not like the models assume.
Okay, why not?
Well, think about stocks. You have tons of analysts, investors constantly digging into company value. But for macro things like currency rates or interest rate differentials, the sources argue there are very few sort of natural market forces specifically designed to make those things perfectly efficient based purely on the fundamentals.
Huh. So that inefficiency, that's where the opportunity lies.
That's exactly what some of these traders are looking for. They're hunting for deviations. They're comparing their own view of the fundamental probabilities, what could happen, against the probabilities the market has already priced in.
So it's about finding where the market's collective brain is just wrong, or at least significantly off on the odds.
Precisely. It's not about having a perfect crystal ball. It's about finding those spots where the market is massively underpricing or overpricing the chance of certain fundamental outcomes.
And this even applies to bubbles,
Right.
which seems counterintuitive again.
Yeah, one perspective shared is that, look, in a bubble, the real true believers might make the absolute most money, but you can still participate carefully. The key is getting in early enough for decent returns. Having a clear plan for when it turns, and this is absolutely critical, being in liquid positions so you can get out fast.
Liquidity.
The 2006-2007 bubble is the example used. Liquidity after it pops is everything. If you structure your trade smartly, maybe using long calls where your max loss is fixed and you can exit easily, that was one way to play it without getting totally wiped out.
Right, limit the downside.
So, okay, that's the macro landscape, spotting opportunities. But how do they actually act on it? How do they trade? The sources make it clear there are many different ways to find an edge, lots of different styles.
Exactly. Like one macro trader, they focus almost entirely on foreign exchange and interest rates. And they mentioned that equity trading, trying to figure out company stories, management teams, all that, it just doesn't really click for them. not like the maybe cleaner dynamics of currencies and rates.
Which just hammers home that point.
Yeah,
You have to find what fits your own wiring, your own interests, not one size fits all.
definitely not.
And get this, sometimes the trade idea doesn't even start with weeks or months of deep fundamental digging. There's that powerful quote from George Soros:
Which one?
invest first, investigate later.
Wait, seriously, invest first, investigate later.
Hmm.
That sounds, well, it sounds almost reckless to a lot of people, I'd imagine.
It does sound that way on the surface, but it's not about being reckless. It's about hypothesis testing in real time. Sometimes the price action itself is screaming that something big is happening fundamentally.
For the reason is obvious.
Exactly. Before the news hits or the analysis catches up. So you can act on that signal, put on a position, maybe a small one initially, and then you scramble to figure out why the market is moving. It's empirical. You're letting the market's behavior be your primary data point.
Okay. Framed like that, it makes more sense.
Yeah.
It's not blind gambling. It's responding to a strong signal and then doing the homework fast.
Right.
So, shifting gears a bit. The sources also go deep on the quantitative approach. Here, the underlying belief is still that markets aren't perfectly efficient, which means, theoretically, you can find systematic patterns, exploitable edges, using models.
And they talk about how these models evolved. Like early on, maybe you'd build a specific model for oil, another for bonds, another for the yen.
Right. Bespoke for each market.
But the sources point towards a more robust way, developing common models. Models that can be applied across many different diverse markets. Because if a pattern holds up in currencies and commodities and bonds, it's much less likely to be just random noise or something quirky about one specific market. It suggests something more fundamental.
But the huge trap in quant world is data mining, isn't it? Just torturing the data until it confesses to a pattern that isn't actually real. Curve fitting.
Absolutely. It's the bane of quantitative analysis. But the sources discuss a really clever way to fight this. Using randomly generated data as your baseline. Create fake market data that has similar statistical properties to the real data, then run your model on both. If your model only performs slightly better on the real data than on the completely random data.
Then your edge is probably mostly luck or noise.
Exactly. Most of your perceived edge is likely spurious. You need performance significantly, meaningfully better than that random baseline to start having confidence you've found something real.
That really raises the bar for proof. Makes sense. And even with these complex models, there's still a human manual element, right? Choosing what data goes in beyond just price.
Yeah, things like volatility or maybe price acceleration, how fast the price is moving. These secondary variables, chosen thoughtfully, can sometimes reveal deeper market dynamics that price alone doesn't capture.
And it's fascinating. Even these super technical quant guys, they often try to reverse engineer their own successful models.
Yeah, they want to understand why it works. What does the pattern the model found actually tell us about the underlying, psychology of the marketplace? They're still trying to connect the math back to the human behavior driving it all.
Okay, so finding the idea, whether macro or quant, is one piece. But making it actually work, making money, that requires a whole different skill set. Execution, risk management. The sources really hammer this home. How a trade is implemented and managed is often more important than the initial idea itself.
This is so crucial. It's not enough just to be right about the direction. You absolutely have to structure the trade to give you the best possible return for the risk you're taking. The return to risk ratio.
Could you give an example of that? Like, how would that play out?
Sure. Think back to the 2007 downturn again. Okay, you expect the Fed to cut interest rates. So buying short-term bonds or longing short-term rates seems logical, right?
Yeah, rates go down, price goes up.
But the sources point out at that specific time, the yield curve was really flat. So instead of just buying short-term rates, a potentially smarter trade was a yield curve spread. You buy the short-term rates and simultaneously sell the long-term rates.
Why? What does that do?
It gives you similar profit potential if short rates fall as you expect, but with much less overall interest rate risk.
Yeah.
Because you're neutral on the overall level of rates. You're basically just betting on the shape of the yield curve changing, steepening, rather than the whole curve just shifting down. You isolate the bet.
Ah, okay. So you're refining the bet, stripping out risks you don't necessarily want exposure to. That's clever.
Exactly. And going back to trading bubbles from the long side, we mentioned participating early but structuring it right. That means using instruments with a limited worst-case loss.
Like options.
Like long calls, yeah. Where the absolute most you can possibly lose is the premium you paid up front. That way, you can ride some of the upside euphoria, but you won't get completely destroyed when, inevitably, the bubble pops. You have a defined, capped risk.
And flexibility. That comes up over and over again. Soros is the poster child for this, apparently.
Yeah.
No emotional attachment to trades, zero ego involved. If the market proves his hypothesis wrong, boom, he's out. No arguments.
The example from April 2009 is just perfect for this. Remember, the global financial crisis was still absolutely raging. He was bearish, understandably.
Right.
But the market started rallying strongly. He didn't dig in his heels and say, the market's wrong. No. He changed his hypothesis. He started to see evidence that maybe the markets were already pricing in the beginning of an Asia-led economic recovery.
Wow.
And because he was flexible, because he listened to the market action instead of his own prior belief, he actually ended up having a profitable year, even though his initial big picture outlook was wrong. That ability to just change your mind based on new evidence is incredibly rare and incredibly powerful.
It really is.
Yeah.
Okay, let's talk stops. Money management, discipline. It's key. But the sources offer a more nuanced take on traditional stop losses, saying that just setting a stop based on, like, I'll get out if I lose X amount of money, that can actually be counterproductive.
This is such a critical distinction. The advice isn't don't use stops, it's how you set them. First, you have to decide, based on your analysis, at what price level your original reason for putting on the trade is no longer valid. Where is the premise fundamentally broken?
Okay, the logical invalidation point.
Exactly. That is where your stop should logically go. Then you look at how much you would lose if the price hits that point. If that implied loss is just too big for your account, too much risk, you don't move the stop closer just to feel better.
What do?
You size the position smaller. You manage the risk by adjusting the size of the trade so that the potential loss at your logical stop point is acceptable. Risk is managed based on the trade's logic, not your personal pain threshold.
That is incredibly practical. Decide where you're wrong first, then size accordingly. Makes perfect sense. And this really ties into that idea of asymmetric trades, right? The kind many successful traders seem to gravitate towards.
Right. They're constantly looking for trades where the potential payoff profile is skewed to the right, meaning your maximum loss is limited, it's defined, maybe even small relative to the potential gain, but your upside, well, theoretically, it could be open-ended or at least much, much larger.
Like options again, or?
Long options are a classic example. Buying CDS protection credit default swaps is another. It's like buying insurance on a bond. Your max loss is the premium, your upside is huge if the bond defaults. Or certain spread trades, like the TED spread back in the crisis, which measures bank credit risk versus treasuries. You can be wrong more often than you're right with these types of trades and still make a fortune if your winners are significantly larger than your losers because of that asymmetry.
And position sizing itself.
Yeah.
The sources argue it might be even more important than nailing the perfect entry price.
It's huge. Trading too large is practically a guarantee you'll make bad decisions. Why? Because your choices become driven by fear of losing that large amount, not by clear, rational analysis.
So how do you know if your size is right?
They suggest you need to trade within your emotional capacity.
Yeah.
And there's a simple practical test they mention.
Yeah.
If you find yourself waking up in the middle of the night thinking about a specific position, it's probably too large for you.
Huh. That's a great simple rule of thumb.
Conversely, when everything aligns, you have a really compelling fundamental reason, the potential reward dwarfs the risk. Your confidence based on your work is high. That's when you should consider sizing up, being more aggressive.
But not recklessly large.
Never recklessly large. And you also need to adjust your size based on market conditions, specifically volatility. If the market starts swinging wildly, volatility spikes. You should generally reduce your position size, your exposure, to keep your actual dollar risk somewhat constant, or even lower it.
So it's a constant dynamic adjustment. It's not set and forget.
Absolutely not. And that ties into the idea of scaling in and out, too. You don't necessarily have to be 100% right on the exact bottom to buy or the exact top to sell. You can build a position gradually as your conviction grows, or take profits off the table incrementally as the trade works.
Makes sense. One last discipline they mentioned sounds interesting. Harvesting losses. What's that about?
It's a proactive discipline. You intentionally close out a losing position, even if maybe you still think it could eventually work out. Why?
Why?
Because closing it forces you to reevaluate completely from scratch. It makes you ask yourself, okay, the position is gone. Do I really want to buy it back right here, right now? Or and this is the key part, would I actually rather put that freed up capital into this other trade idea I have, which frankly looks a lot better at this moment? It forces capital allocation discipline. It prevents you from just sitting on losers hoping they come back.
Okay, let's shift focus a bit. Beyond the charts, the models, the mechanics, there's the deeply human side of trading. The sources don't shy away from this. They share some pretty raw anecdotes about dealing with failure, intense pressure, the whole emotional roller coaster.
Yeah, stories about, crippling early losses that almost took them out of the game, or
Yeah.
just that relentless feeling of being kicked around by the market day after day when you're trying to grind out a living.
Those stories are important, right? Because they show the kind of resilience, the humility, the sheer discipline that's required.
Absolutely. And they also reveal some really common mistakes, the traps that traders fall into. Averaging down on losing trades comes up again and again. It's highlighted as maybe the single biggest reason traders blow up entirely.
Because you're essentially fighting the market's message.
Exactly, instead of listening to it. Another big mistake mentioned is deviating from what you actually do best. Maybe you get bored with your strategy, or you get overconfident after a winning streak, or you see someone else making money doing something different and think, I should try that.
Even if it doesn't fit your skills or temperament.
Right. Also, simply not knowing why you're winning or losing. Not rigorously analyzing your past trades to understand your actual edge, your weaknesses. That's a huge blind spot for many.
And maybe diversifying too much, spreading yourself too thin.
Yeah, diversifying away from your core area of expertise just because you can trade other markets. It can actually dilute your edge rather than reduce risk effectively.
But the insights on learning are pretty encouraging, I thought. The idea that while maybe you can't strictly teach trading in a classroom like physics,
Yeah.
it absolutely can be learned.
Definitely. Through hard-won experience, through study, through intense self-reflection, it really comes back to finding the style, the time horizon, the specific markets that genuinely resonate with your personality, your skills, your way of thinking.
And discipline.
Well-
Keeps coming back to discipline. Easy when things are going your way,
Right.
but maintaining that discipline when the market is tough, when you're losing money, when nothing seems to be working, that's what separates the truly great traders from everyone else.
Yeah. Some traders also talk about developing this almost intuitive feel at an internal radar for major turning points. But that's not magic. It's built up over years and years of intense observation and pattern recognition. Experience.
What really struck me was the idea that even these incredibly successful traders might not be trading in the most optimal way relative to their own unique edge.
Can you elaborate on that?
Well, there's an example given of a trader who was apparently phenomenal at identifying major market tops and bottoms, like nailing the big turn. Incredible skill.
Okay.
But then they would only trade the very first part of the huge long trend that inevitably followed that turn. Why? Because that's just how they'd always done it. That was their established style. They were leaving massive potential profits on the table simply because they weren't fully leveraging their core forecasting skill across the whole move.
Wow. That really makes you think, doesn't it? It raises such an important question for anyone, really. Are you applying your own unique skills, your own insights, in the way that best aligns with maximizing your potential edge? It's a call for continuous self-assessment, even when you're already successful.
Yeah, are you leaving money on the table because of habit? The sources also introduced this really interesting performance metric, not one you hear about every day, the gain-to-pain ratio, GPR.
Ah, yes, the GPR. It's a fascinating metric. How's it calculated again?
You take the sum of all your monthly returns, all the positive months added together. Then you divide that by the absolute sum of all your monthly losses, ignoring the minus signs, just adding up the magnitude of the losing months.
Okay, so total gains divided by total pain, basically.
Exactly. What makes it powerful is how severely it penalizes drawdowns and losses.
Hmm.
A big losing month really hurts your GPR, but it also rewards the upside volatility of your winning months.
So it favors strategies that make steady gains but really avoid big hits, or make huge gains that dwarf the losses.
Both, really. A GPR above 1.0 is considered very good, excellent even. It suggests you're not just generating returns, but you're doing it efficiently, without enduring massive cumulative pain along the way.
That makes sense. It focuses on the quality of the return stream, not just the total return number.
Right. And shifting to how these wizards might pick other money managers, there's this really powerful, almost contrarian insight. The sources argue that looking purely at past performance, it's often useless.
Sometimes worse than useless, actually.
Really? How so?
Well, the argument is that past performance has very little predictive value for future results. Sometimes, outstanding past performance might have been achieved through taking excessive, unsustainable risks that just happen to pay off during that specific period.
So focusing on past returns can be misleading.
Yeah.
What should you focus on instead?
The manager's process. How do they think? What's their philosophy? How do they generate ideas? Crucially, how do they manage risk? What are their disciplines? Sometimes a manager who actually underperformed during, say, a crazy bubble phase
Hmm.
might actually be demonstrating superior skill and prudence. They stuck to their disciplined process while everyone else was getting reckless and chasing returns. So, ironically, that period of underperformance could be a positive sign about their process. Past performance can even be an inverse indicator sometimes.
Wow, that completely flips the conventional wisdom on its head. Focus on the process, not the outcome. Finally, there was that brilliant, almost kind of sneaky technique mentioned for getting information.
Ah, you mean asking people for their opinion?
Yes, just asking their market opinion. Why is that supposed to be so effective?
Because, according to the sources, there's an almost perfect, like 100% correlation between someone's short-term market forecast, say, their 3-month outlook, and their current market position.
No way.
Yeah. So if you ask them what they think is going to happen, you're very, very likely deducing what they're actually doing, what their exposure is, without having to ask them that directly, which they might not tell you. It's a subtle way to gauge market sentiment and positioning.
It's pretty incredible how these ways of thinking, this analytical rigor, this constant search for value, the focus on process, they aren't just confined to financial markets, are they?
Not at all. The sources touch on this briefly, giving an example of applying these same principles outside finance, like taking that analytical, problem-solving, inefficiency spotting approach to a field like education reform.
How would that work?
By looking for what actually works based on evidence, identifying where the system is inefficient or failing, and focusing resources there, just like finding mispricings or inefficiencies in the market.
So it reinforces that the core skills, critical thinking, rigorous analysis, finding value where others don't see it, disciplined execution, these are really universal tools.
Absolutely. Applicable far beyond just trading.
So let's try to wrap this up. What are the really big takeaways, the key lessons we've unpacked from this deep dive into the minds of these market wizards?
Well, first, I'd say you absolutely have to understand the bigger picture, the macro landscape, fundamentals, global forces, policy. They drive the really significant market moves. And remember, macro markets are often not efficient, which creates opportunity.
Okay, big picture first. What else?
Second, there is no single right way. Finding your edge is deeply personal. It could be discretionary macro, it could be quant systems, it could be spotting fundamental mispricings, maybe being a flexible contrarian. The crucial thing is finding an approach that genuinely fits you, your personality, your skills.
Right, find your fit. And third,
Third, none of that matters. Not the view, not the style, without absolutely rigorous execution and risk management. Structuring trades for that asymmetric payoff, sizing positions so you can sleep at night, being incredibly flexible and willing to change your mind, setting stops based on logic, not emotion. These disciplines are just non-negotiable.
and kind of woven through all of that is the constant need for self-reflection, right? Learning honestly from your mistakes, maintaining discipline even when it's hard, and really mastering the psychological side of the game. That seems paramount.
Definitely. Finding an approach aligned with who you are and then relentlessly refining your process. That seems far more important than chasing some mythical secret formula that probably doesn't exist anyway.
Yeah, I think this deep dive into these sources really offers perspectives on markets, on risk, on decision-making that you just don't get from reading the daily headlines or watching financial news.
Agreed. It's much deeper.
So here's a final thought for you, our listener, to maybe ponder on after this deep dive. Given this incredible diversity of successful approaches we've talked about, and that constant emphasis from these wizards on finding what uniquely fits you, what's the single most powerful lesson from their collective experience that really resonates with you right now? And perhaps more importantly, how could you start applying that lesson to your own learning, your own endeavors, whether that's in the markets or, frankly, anywhere else in your life?